What you are witnessing right now in the silver market is not a routine price move, and I want you to understand that clearly. I have followed commodity cycles, currency crises, and debt shocks for many years, and the behavior we are seeing in precious metals, especially silver, carries the same kind of warning signals that preceded major financial shifts in the past. Prices are not just rising, they are surging, pulling back violently, and then surging again. That kind of motion is rarely random. It usually means that something deeper inside the financial system is under strain. If you look closely, the first signals were subtle. Volatility began increasing before most headlines appeared. Futures markets showed unusual intraday swings. Inventories started tightening, and spreads between physical and paper markets began to widen. These are the kinds of fractures that experienced observers recognize immediately. Markets often whisper before they scream, and silver has been whispering for months. The same pattern appeared in energy markets before the 2008 spike, and in sovereign bond spreads before the European debt crisis intensified in 2011. Small distortions grow quietly until they reach a tipping point. Now, let me explain what is really driving this. At the core, this is a macroeconomic story about confidence. Governments across the world are carrying historically high debt burdens, and interest costs have climbed to levels that were almost unimaginable a decade ago. Central banks are walking a narrow path. If they keep rates high, debt becomes harder to service. If they cut too quickly, inflation risks returning. That tension creates uncertainty, and uncertainty always pushes capital toward assets that are perceived as stores of value. Gold traditionally plays that role, but silver behaves differently. Silver reacts not only to monetary fears, but also to industrial demand, especially from energy transition technologies, electronics, and advanced manufacturing. That dual nature amplifies every move. What makes this moment even more significant is that these signals are not isolated to one country or one exchange. When you look at global liquidity conditions, you see money supply stabilizing but still elevated. When you examine currency markets, you see persistent pressure on major reserve currencies as fiscal deficits widen. When you track central bank behavior, you see continued accumulation of gold and a growing strategic interest in raw materials. These are not speculative retail flows. These are structural decisions made by institutions that think in decades, not quarters. And when institutions act in that way, it usually reflects a broader shift in the economic landscape. But here is where the contradiction appears, and this is important. At the same time that metals are signaling stress, equity markets in several major economies remain resilient. Corporate earnings, particularly in technology sectors, continue to support valuations, and investors are not behaving as if a full-scale crisis is imminent. Bond yields have stabilized rather than spiking uncontrollably. Inflation has moderated from its peaks, even if it remains stubbornly above long-term targets. So you have two messages coming from the financial system at once. One market signaling caution and fragility, another projecting confidence and stability. Whenever you see that divergence, it means the system is in transition, not equilibrium. And this brings us to the conclusion you should understand at this stage. Silver is not simply rising because of speculation or short-term excitement. It is reacting to a convergence of structural forces, debt dynamics, monetary policy uncertainty, industrial demand shifts, and geopolitical risk that are building pressure beneath the surface of the global economy. I am not telling you what will happen next, and I am not here to tell you what to buy or sell. But I am telling you this with absolute conviction, based on years of watching crises unfold. When multiple macro signals begin to align while markets send conflicting messages, it means we are approaching a turning point. The story is not finished yet, and what happens next will depend on how those pressures resolve in the months ahead. I need you to focus for a moment, because what we are seeing now is the stage where markets stop sending quiet signals and begin to send unmistakable warnings. When volatility accelerates and price swings become violent, it is rarely about emotion alone. It is about stress moving through the plumbing of the financial system. I have watched this happen in different forms. During the 2000 tech unwind, during the 2008 liquidity seizure, during the 2020 pandemic shock. And there is always a moment when the surface looks calm while the internal mechanisms begin to grind. That is exactly where we are standing now. Look closely at what has been happening beneath the surface. Real yields have been drifting, not collapsing, but losing the stability that investors depend on. Currency markets are showing fatigue, with the dollar weakening in waves rather than trending in a clean direction. That kind of behavior tells you that capital is moving, searching, repositioning. At the same time, sovereign debt levels remain at historic highs. Governments are rolling over massive quantities of debt at interest rates far above what they paid a few years ago. That pressure does not explode overnight. It builds quietly month by month, budget by budget, until it begins to shape policy decisions. When policymakers become constrained, markets begin to anticipate those constraints long before they are visible in headlines. Now, think about liquidity, because liquidity is the oxygen of the financial system. Global money supply is still elevated, even after tightening cycles. Central banks have slowed the pace of contraction, and in some regions they have begun quietly expanding again through targeted measures, refinancing operations, or reserve requirement adjustments. These actions are not dramatic enough to dominate news cycles, but they matter enormously. Every time liquidity stops shrinking and begins to stabilize, hard assets tend to react first. That is not a theory. It is a pattern visible across decades, from the inflationary 1970s to the post-2008 quantitative easing era. At the same time, industrial demand is creating a second layer of pressure, and this is something many people underestimate. The global economy is undergoing a structural transformation. Energy systems, manufacturing chains, electrification, data infrastructure. And these shifts require enormous quantities of metals. Silver is embedded in photovoltaics, advanced electronics, and high-efficiency conductors. Demand does not always rise smoothly. It often accelerates in bursts when large projects or policy incentives align. That means supply chains, which were designed for steady growth, suddenly find themselves struggling to keep pace. And when supply struggles, volatility is not an accident. It is the market trying to ration scarcity. But I want you to notice something even more important. Institutions are behaving differently. Central banks, sovereign funds, and large asset managers are adjusting allocations in ways that signal caution, not panic, but preparation. When institutions prepare, they are not reacting to headlines. They are reacting to long-range models, to demographic trends, to debt sustainability projections, to geopolitical risk assessments. These actors are not concerned with next week's price. They're concerned with the next decade's stability. And when that kind of capital begins to move, the effects ripple slowly at first, then all at once. You may also be sensing a contradiction, and you are right to sense it. Equity markets have not collapsed. Corporate earnings in certain sectors remain strong. Employment data in major economies has not deteriorated dramatically. On the surface, the system appears functional, even optimistic. But markets are layered, and different layers react to different timelines. Equity investors often focus on quarterly earnings and technological growth cycles, while metals markets react to monetary regimes, debt cycles, and geopolitical tension. Those timelines do not always align. In fact, history shows they rarely do. In 2007, equity markets reached record highs, while credit markets were already signaling deep stress. The divergence did not last forever. I want you to understand this clearly. Divergence is not stability. Divergence is tension. It is a sign that different parts of the system are pricing different futures. And when those futures finally converge, the adjustment can be abrupt. Sometimes it resolves through growth catching up and validating optimism. Other times it resolves through risk repricing and volatility spreading outward. No one can predict the exact trigger, but experienced observers know how to recognize the buildup. So, as you listen to me, do not think of this as a story about one metal or one market. Think of it as a lens through which we can observe the entire global financial structure. Silver is volatile because it sits at the intersection of monetary fear and industrial necessity. Gold is steady because it reflects long-term confidence in value preservation. Bonds are cautious because they reflect policy uncertainty. Currencies are restless because they reflect capital flows searching for safety. Each market is speaking in its own language, but they are all describing the same underlying reality. The global system is adjusting to a new era of debt, liquidity, and geopolitical fragmentation. And I am telling you this directly, looking you in the eye as if we were standing in the same room, because I have seen how quickly these adjustments can accelerate once momentum builds. The warning signs are not dramatic explosions. They are subtle fractures, misalignments, and sudden bursts of volatility that appear and disappear before most people notice. But if you have watched enough cycles, you recognize the pattern. We are not at the end of the story. We are in the middle of a transition, and transitions are always the most unstable part of any financial era. I want you to pay very close attention now, because this is the point where many people misunderstand what is really happening. They look at charts, they see price spikes, and they assume this is just another speculative wave, another short-term frenzy that will fade. But when you step back and look at the structure of the market itself, you begin to see something far more serious unfolding, something that has appeared at critical moments in financial history. You have to understand the difference between a market that is volatile because traders are emotional and a market that is volatile because the underlying structure is under strain. Those are two completely different things. Emotional volatility fades quickly. Structural volatility persists, deepens, and eventually forces a repricing. What we are seeing now in silver has many characteristics of structural stress, and I say that carefully, based on patterns I have studied for years. One of the clearest signals is the growing tension between paper markets and physical markets. Most people do not realize how leveraged commodity markets have become over the decades. Futures contracts, derivatives, and synthetic exposures allow enormous volumes of metal to be traded without the metal itself moving. This system works as long as confidence remains intact and delivery demands stay predictable. But when confidence weakens or demand for physical settlement rises, the leverage becomes visible. Inventories that once seemed sufficient suddenly look thin. Delivery timelines become sensitive. Premiums begin to appear in different regions. These are not theoretical risks. They are observable phenomena that have appeared repeatedly in the past. If you go back to the London gold pool collapse in the late 1960s, you will find a similar pattern. For years, official mechanisms kept prices stable on the surface, but pressure built underneath as physical demand drained reserves. Eventually, the system could no longer maintain the illusion of stability, and the structure broke apart, leading to a complete transformation of the monetary order in the following decade. I am not saying history repeats in identical form, but financial systems do rhyme, and the rhyme we are hearing now is unmistakable. Another signal that should not be ignored is the behavior of spreads and ratios. When the relationship between gold and silver begins to compress rapidly, it often indicates that capital is rotating toward higher beta hedges, assets that amplify the same macro forces driving gold, but with greater sensitivity. That shift usually happens when investors begin to sense that the cycle is entering a new phase, one where volatility itself becomes a defining feature. We saw comparable behavior in the mid-1970s, and again in the period leading up to the 2011 commodity peak. Each time, the move was not driven by a single event, but by a broad revaluation of risk across currencies, debt markets, and real assets. At the same time, I want you to notice the signals coming from logistics and supply chains. Mining output does not increase overnight. Refining capacity cannot expand instantly. Transportation routes, geopolitical constraints, export policies, all of these factors create bottlenecks that take years to resolve. When demand accelerates while supply remains constrained, the market does not adjust smoothly. It adjusts through volatility. Prices move violently not because the metal suddenly became more valuable in a philosophical sense, but because the market is struggling to discover a level that balances real-world supply with real-world demand. But here is where the situation becomes even more complex. While these pressures build, the financial system continues to operate. Payments clear, markets open each morning, and most people go about their daily routines without sensing any immediate disruption. This is how systemic transitions usually unfold. They do not announce themselves with a single dramatic headline. They develop in layers, quietly, persistently, until a catalyst forces everyone to pay attention at once. The catalyst is rarely predictable, but the buildup is always visible to those who know where to look. I am speaking to you directly because I want you to understand the magnitude of what structural stress means. It does not mean collapse is imminent. It does not mean panic is inevitable. It means the system is becoming more fragile, more sensitive to shocks, more reactive to policy decisions and geopolitical events. Fragility is not dramatic in the beginning. It is subtle, almost invisible, but it changes how markets behave. Movements become sharper, recoveries become less stable, and correlations that once held steady begin to break apart. And that is exactly what we are witnessing now. Relationships between currencies, bonds, equities, and metals are shifting in ways that cannot be explained by a single variable. It is the convergence of debt cycles, monetary policy limits, resource constraints, and geopolitical fragmentation. These forces do not operate on a weekly timeline. They unfold over years, sometimes decades. But there are moments like this one when the pace accelerates and the signals become impossible to ignore. So I need you to hold this perspective in your mind as we continue. Do not think of silver as an isolated market. Think of it as a pressure gauge attached to a much larger machine. When the gauge begins to fluctuate violently, the question is not only about the gauge itself, it is about what is happening inside the machine. And right now, the machine of the global financial system is running under pressures that have not been seen in a generation. Now, I want you to step back with me and look at the full picture, because this is the moment when all the signals we have been discussing begin to converge. You have rising volatility in metals, persistent structural deficits in some commodities, debt levels that continue to climb, and central banks that are no longer able to tighten or ease without consequences. These forces are not isolated events. They are parts of a single macroeconomic landscape that is shifting beneath our feet. I have watched cycles like this before, and there is always a phase when uncertainty becomes the dominant driver of market behavior. That is the phase we are entering now. Think about how financial systems evolve over long periods of time. After the Second World War, the Bretton Woods system created stability for decades, but by the late 1960s, the pressures of deficits and currency imbalances began to erode that stability. The breakdown did not happen in a single day. It unfolded gradually until the moment when convertibility ended and a new monetary era began. In the late 1990s, we saw another transition as globalization and technological expansion reshaped capital flows, culminating in the dot-com bubble and its collapse. After 2008, quantitative easing and ultra-low rates created yet another regime, one defined by abundant liquidity and rising asset prices. Each of these transitions felt uncertain and confusing while they were happening, because people were trying to interpret signals that did not fit the old framework. What makes the present moment different is the number of constraints that policymakers face simultaneously. Inflation has cooled, but has not disappeared. Debt servicing costs are consuming larger portions of national budgets, and geopolitical fragmentation is reshaping trade and capital flows. Central banks cannot simply flood the system with liquidity without risking renewed inflation, but they also cannot maintain restrictive policies indefinitely without increasing the risk of financial instability. This is what economists refer to as a policy trap, and history shows that policy traps often lead to prolonged periods of volatility rather than clear, stable trends. I want you to also consider the psychological dimension, because markets are ultimately driven by human behavior. Confidence is not a constant. It rises and falls in waves. When confidence is high, investors overlook risks, leverage expands, and volatility remains low. When confidence begins to erode, even slightly, the same system can react violently to relatively small shocks. That is why you sometimes see sudden moves that appear disproportionate to the news that triggered them. The news is only the spark. The real cause is the accumulation of tension over time. Another factor that cannot be ignored is the growing divergence between regions. The United States, Europe, and Asia are not moving in perfect synchrony anymore. Monetary policy paths differ, growth expectations differ, and currency dynamics differ. Capital flows respond to these differences, and those flows influence commodity markets in complex ways. When one region injects liquidity while another tightens, exchange rates shift, trade balances adjust, and the relative pricing of real assets changes. These are not abstract textbook concepts. They are forces that shape the behavior of markets every single day. And yet, despite all of this complexity, there is a simple truth that experienced observers recognize. Financial systems move in cycles, and cycles eventually reach turning points. A turning point does not always mean a crash or a crisis. Sometimes it means a gradual but profound revaluation of assets, currencies, and expectations. The turning point is the moment when the assumptions that guided the previous decade no longer hold, and new assumptions begin to take their place. We are approaching such a moment now, not because of one headline or one policy decision, but because multiple structural forces are converging at the same time. I am speaking to you directly because I want you to understand that what we are witnessing is not noise. It is information. It is the market's way of signaling that the global economy is entering a new phase, one shaped by higher structural debt, persistent geopolitical tension, technological transformation, and a rebalancing of monetary power. These transitions are never comfortable, and they are rarely predictable in their timing, but they are unmistakable in their direction once you learn to recognize the signs. So, as we come to the end of this analysis, I want you to remember one thing above all else. Markets do not change overnight, but they do change. The signs appear first in places that most people ignore, in volatility spikes, in subtle shifts in correlations, in the quiet movements of institutional capital. By the time the change becomes obvious, the transition is already well underway. What we are seeing now, in silver and in the broader macro landscape, is one of those early signals, a reminder that the financial world is not static but constantly evolving. And those who pay attention to the signals, who step back and observe the larger pattern, are the ones who truly understand what is happening as history unfolds in real time.